I guess markets reacted to this kind of a narrative a week before, which is that in the run-up to the Fed commentary, US markets had already corrected. The 10-year paper had already marched up to 3.9 or about 4%, and the dollar index had gone up from 103 to 105. So, frankly, from a market standpoint, this is not new, and the market reaction is something which already got adjusted. I will not read too much into it, with the exception that if the bond yields in the near term, if they start moving higher and if they go dangerously higher above 4% or dollar index starts moving towards 110, I don't think from a market standpoint this is something which would be an incremental worry. Interest rates will remain high, interest rates will remain high for long. That factor, I think, is something which markets are already aware of, and large part of price adjustment is behind us. What it also does is that it really limits the upside. I mean, if you know interest rates are high, then that means whatever surprise markets were anticipating in the second half of the year, that gets diluted. So that is a problem, if you ask me.
Yeah, for our markets as well, though, while we are finding support at the crucial levels around 17,800 odd, having said that, we are definitely trading at the higher end of the trading range. Having said that, yesterday it was a steep recovery that our market saw, even though we started off on a ghastly set of global cues. You did see a very, very smart recovery from the session lows. In fact, we turned out to be the region outperformers of sorts. Good recovery in the Adani names, good recovery in some of the select banking names as well. And FIIs, by the way, were big buyers yesterday, couple of block deals there as well. But we were in excess of 16,000 crore rupees. That's the quantum of FII buying that one has seen month to date. Of course, it's also been led by large block deals that have happened. So we're managing to hold on to that budget day low and clearly escaping that at 17,350 thereabouts.
So, Aisha, you put all those four factors together, you could ask yourself, okay, do we have a bottom in place? Looks like we have, at least for a Nifty watcher. B, large part of the sentimental rub-off which had happened largely because of Adani group of stocks, at least for Adani group of stocks and also for lenders and for the banking sector per se, that clearly is on the back burner now. And C, in patches, but I guess the directional move of FIs now is on the positive side rather than on the negative side. So after a very lull start to 2023, are markets rediscovering their mojo? B, are we in for a gradual rise, but directionally are we headed higher? Second. And B, if markets in a sense are going to be directionally positive, now you may not see a straight line move, but directionally and incrementally, if you're trading with the positive bias, are we likely to go back to a outperformance in small and mid cap stocks? And if that's not enough, I guess Bank Nifty, which in a sense is a pivot for me, it's not going to be IT, it's not going to be metals, that pivot index is also outperforming. So based on the factors what we discuss, you could ask yourself is, what is a trade? I think it's a long trade. You could ask yourself is that, what is the bias? The bias is positive. Give this market some more days, and if you stay where you are, and even if you stay moving in around a narrow band with a positive bias, then the market outlook suddenly will start looking different, because markets will start talking about FY24, they'll start talking about next earnings season, they'll start talking about a consolidation which has happened, because you are in March, and exactly 4 weeks from now, we will be talking about Q4 earnings season and FY24 outlook. So that narrative changes.
Yeah, and the triggers are going to be largely the focus on local cues, as you're talking about, that we'll be flagging off. So as of now, Nikunj, you're saying the strategy for the long term is to stay invested, to remain quite patient. Would that hold true even when it comes to investments within the broader markets, the mid and the small caps?
I think you will see outperformance. For example, sugar yesterday.
Yeah.
I mean, out of the blue, it's a what is sugar? Sugar as a sector is patronized by traders. It's a sector which is patronized by HNI investors. Now, nothing has changed. I mean, sugar prices were at a 7-year high, but they were at a 7-year high 10 days ago also. So why have we seen this kind of an sudden sugar rush, if I may use the word, for sugar stocks? And that's largely because markets took notice of that. You start taking notice of positive things where the market is in a positive frame of mind and when you are ready to take a risk. So are markets, are traders now ready to take a risk? If yes, then you may see pockets of outperformance which will start happening in mid and small cap stocks. So for example, in the second half of trade yesterday, you saw all the fintech and consumer stocks made a comeback. Sugar I've already mentioned. So I think that really should be the hunting ground now. If markets trade the way they've traded for next couple of days, then you will see these large pockets which are dominated by mid and small cap stocks suddenly getting noticed on everyone's radar.